For as long as I can remember, we've all been told the same thing. Renting is just throwing money away, that buying a house is the only smart way to build wealth. But what if that idea, the one that drives our single biggest financial decision, is actually based on a huge mathematical lie? Well, today, we're going to take that lie apart piece by piece, using a simple little rule that could literally save you a fortune.
Okay, so to make this real, I want to tell you a story about a guy named Jason. This isn't just theory. Jason did everything that we're all told is the right thing to do. And his story is, well, it's a perfect cautionary tale about the gap between what we're told and what the numbers actually say.
So Jason's 28, and he is just sick and tired of hearing that he's throwing money away on rent. You know the feeling, right? His parents are on his case, all his friends are buying places. It feels like the whole world is telling him it's time to build some equity. So he gives in. He decides to buy a house. And this was it, a $420,000 house in a suburb of Denver. He's not just thinking of it as a place to live, of course. In his mind, this is the cornerstone of his financial future. It's a smart investment that's just going to go up and up in value. Or so he thought. To make it happen, he puts down 10%. But listen to this. This wasn't just some extra cash he had lying around. That 42 grand was his entire life savings. I mean, every single dollar he had worked and scraped to put away. It was a massive leap of faith, but he was convinced it was the right one. And that became his new monthly reality. His total housing cost jumped from $1,900 for a pretty nice apartment all the way up to almost $3,300. But that's okay, right? Because this is an investment. This is building equity. This isn't just an expense like rent. Is it? And here's the number that just stops you in your tracks. 4 years after buying that smart investment, Jason did the math, and he was $45,000 poorer than if he had just stayed in his apartment and invested the difference. He had gone backwards. He had less wealth, not more. So you have to be asking yourself, how on earth is that even possible? How can you follow the most common financial advice in America and end up literally destroying your wealth instead of building it? Well, to get the answer, we have to tackle the biggest myth in all of personal finance. It all comes down to this one idea, this one phrase. This is what led Jason and honestly millions of other people down the wrong path. It's a story that's so powerful, so ingrained in our culture, that we almost never stop to actually check the math. But that's exactly what we're going to do right now. You see, the lie sets up this false choice. It frames the decision as option A, you can throw your money in the garbage by renting, or option B, you can be smart and build your wealth by owning. But that frame is dangerously incomplete. It's designed to hide a huge chunk of the real story. Okay, so look at this. It really reframes the whole thing. With renting, the money you throw away is super obvious. It's your rent check. It's gone forever. But here's the secret. With owning, you are also throwing money away every single month on stuff that doesn't build a single cent of equity. The only difference is those costs are almost invisible. So, how do we make those invisible costs visible? Well, it turns out there's this brilliant little tool for that. It's a super simple calculation that basically acts like an X-ray for homeownership. It's called the 5% rule, and it lets you see the true financial picture. Now, the point of this rule isn't to say renting is always better. Not at all. It's just to give you a clear, totally unemotional, mathematical break-even point. It tells you exactly when the unrecoverable costs of owning become cheaper than the unrecoverable cost of renting. It's all about finding that financial tipping point. And this chart shows you exactly where that 5% comes from. Every single year, you can pretty much count on throwing away about 1% of your home's value on property taxes. That's money you never see again. Then there's another 1% for maintenance and repairs. And then there's the really big one, 3% for what's called the cost of capital. That's the mortgage interest you're paying plus the money your down payment could have been earning if it wasn't locked up in your house. So this is the key. This is the whole thing in a nutshell. You take the price of a house you're thinking about buying, you multiply it by 5%, and that gives you your annual break-even cost. If you can rent a similar place for less than that number, then the math is clear. Renting is the cheaper, smarter financial move. It's really that simple. All right, let's put this to the test in the real world. Check out San Francisco. The 5% break-even rent on a typical home is a staggering $5,000 a month. But you can actually rent a similar place for $3,200. So yeah, it is way cheaper to rent there. Same story in Austin. But then look at Cleveland. The break-even rent is under $1,000, but the actual rent is higher. In a market like that, buying suddenly starts to make a lot more sense. It's totally different everywhere you go.
Okay, I can practically hear you screaming at me right now. Hey, you're totally forgetting about appreciation. Houses go up in value, and that makes up for all those other costs. And you know what? That is the final, most powerful pillar of the ownership myth. And the real data, it tells a very, very different story. That little number comes from Nobel Prize-winning economist Robert Shiller. He looked at housing prices over the very long term, and after you account for inflation, the average American home has only really appreciated by about 1% per year. That's it. Not the crazy returns we all imagine. It barely even beats inflation. And when you put that 1% return next to other boring, regular investments, the picture gets even more stark. I mean, look at this. As a pure investment, housing has historically gotten smoked by something as simple as bonds, and it's not even in the same league as the stock market. It's just not the wealth-building superstar we've been told it is.
And here's the crazy part. The 5% rule is actually being kind of nice. It doesn't even fully capture the massive transaction costs when you go to sell. I mean, 5 or 6% of your home's entire value just vanishes into thin air. It doesn't account for the fact that it can take 7, 8, even 10 years just to break even. And it definitely doesn't account for that gut punch feeling of getting a surprise $15,000 bill for a new roof. So look, the point of all this is absolutely not to say never buy a home. The point is to give you the tools to make an empowered, smart decision for yourself, one that's free from all the pressure and all the myths. So here's how you can actually do it. This is your personal calculator. It's a 5-step game plan. Step 1, find a realistic house. Step 2, run the 5% rule to find its break-even rent. Step 3, compare that to what's actually available. And then step 4 is the most important one. You have to be brutally honest with yourself. Are you sure you're going to stay put for at least 7 to 10 years? If not, buying is almost a guaranteed way to lose money compared to renting. And finally, step 5, project it out and see what your wealth could look like either way. And this right here is the big mindset shift. Renting isn't throwing money away. It's just paying for a place to live. And you know what? Owning is also paying for a place to live. It just has a much more complicated and often more expensive cost structure. The goal shouldn't be ownership. The goal should be to choose the cheapest, most efficient way to live in your city for you right now. So, at the end of the day, it really all boils down to this one simple question. Are you making your biggest financial decisions based on hard numbers, or are you making them based on old stories you've been told? You now have the tool to separate the financial facts from the cultural fiction. You can run the numbers yourself and decide with your eyes wide open.